You are being trained to panic at the wrong moment. And while you're watching the price tick up on your phone, the real transfer of wealth is already happening, quietly, through interest rates, taxes, currency moves, and the simple fact that central banks write the rules and everyone else pays. This is not financial advice, this is financial education. And in 2026, the uncomfortable truth is this: the next currency fight will not look like a movie. There will be no tanks on the street. There will be no dramatic default announcement that makes headlines. The fight will show up as a slower death for the middle class, higher costs for living, and a market that keeps cheering while your purchasing power keeps shrinking. You might be wondering what this has to do with gold, or with the Fed, or with your job being replaced by an algorithm, or with housing that feels permanently overpriced. The answer is that all of it is connected. The same system that makes it harder to keep a job is also the system that makes money less stable, and stable money gets concentrated with the people who already have leverage. Let me explain the logic in plain English, but with the hard edges left on. In 2026, you live in a world where the headlines say inflation is cooling and interest rates are normalizing. But your grocery bill, your rent, your insurance, and your credit card stress do not care what the headline says. Purchasing power did not snap back to 2019. It never will. And when purchasing power is under pressure, the first thing ordinary people do is look for safety. The second thing they do is get manipulated into the wrong safety. Here is the first lie you were taught: work harder, save more, and you can catch up. That lie was already shaky before AI started swallowing mid-level jobs. Now it looks completely fictional. Because when AI reduces hiring, income growth slows, while the cost of everything that keeps you alive keeps rising. You are not competing with other workers anymore. You are competing with machines that do not get tired, do not need benefits, and do not negotiate for higher wages. And then you are told to invest in what everyone invests in: index funds, retirement accounts, a diversified portfolio of stocks and bonds. You do that because you want to play by the rules, but the rules keep changing in ways you never vote on. That is what a currency war is, by the way. Not fireworks. Rules changing so that the winners are always the ones with the keys. Now we will walk through the mechanics that nobody wants to say out loud. How central banks use rate policy and balance sheets to shift wealth. Why gold behaves differently from what people assume. Why it's over when the Fed stops hiking is not the same as the fight is over. And why the safest assets keep getting pulled toward the same few vaults. Remember, the one person you can always rely on in this story is not your employer. It is not the government. It is not the bank app. It is the institution that controls the supply of money and the cost of liquidity. That institution is the central bank. And in 2026, central banks are not just managing inflation, they are managing power. First, let's talk about the simplest move that changes everything: interest rates and balance sheet expansion. Central banks do two major things: they set the price of money through interest rates, and they expand or shrink their balance sheet by buying and selling assets, which effectively injects or drains liquidity. In 2008 and in 2020, people learned the same pattern the hard way. When the Fed adds liquidity, markets inflate. When liquidity gets tighter, risk gets punished. But here is where it turns dark. In a currency fight, you do not only have one player, you have rivals watching each other. If one central bank moves first, they set the terms for everyone else. In the real world, smaller or more aggressive central banks often act as a pressure valve or as a preview. They expand liquidity earlier, or they adjust policy faster, and then other countries follow with their own version. Think of it like a race where everyone claims they are running, but one team is actually pumping tires with air, while everyone else is still tying their shoes. In 2020, the world saw rates and asset purchases change fast, but in many cases, policy timing across countries created opportunities that regular investors could not access because they lacked the access, the instruments, and the government connections. If you are a regular person, your policy access is limited to whatever your bank offers you and whatever your employer pays you. That is why the middle class gets hit first and hit last. First, because wages do not adjust instantly. Second, because debt and rent and basic expenses adjust slower and then adjust all at once. Meanwhile, the people with capital can shift faster. They can buy assets before the public understands what's happening. Now for the next painful point. When rates rise, you think the winners are people with cash. But the real winners are people who can borrow cheaply when others cannot, and then move into the assets that keep their value when currency pressure starts. And you can see that happening in 2026 through gold demand, currency weakness, and how markets behave after rate announcements. Even when policymakers sound calm, money is still moving. The same liquidity channels that inflated tech stocks and real estate before can rotate into safety when the risk becomes obvious. You have to understand one thing. A central bank does not need to destroy your country to extract wealth from it. It only needs to make your currency less valuable over time relative to the assets it prefers. That brings us to the key mechanism that turns this into a currency war with no smoke. You are not watching weapons because the weapons are arithmetic. If the Fed stops hiking or pauses, people act like the danger ended. It didn't, because the currency fight does not only depend on what the Fed does this week, it depends on what central banks are preparing to do next. It depends on balance sheet plans. It depends on whether liquidity is tightening or loosening behind the scenes. Also, rates do not have only one effect. Higher rates pull money toward dollar assets, strengthen the dollar at times, and squeeze risk. Then when rates stop rising, or when the Fed signals a shift, the market does not automatically become stable for you. It becomes volatile for everyone. And volatility is where leverage wins. Here's a micro story. Picture a 32-year-old nurse named David. He works nights. He does not have time for macroeconomics. He just wants health insurance and a mortgage payment that stays predictable. In 2020 and 2021, he tried to buy a house. The numbers did not make sense. By 2022, his rent increased and his savings got eaten by higher food and higher insurance premiums. Then he heard about interest rates going down in the future. So he waited. He waited because he thought lower rates would finally help him. Now it's 2026. Rates have changed again. His income did not triple, but housing prices did not come back to earth. His monthly payment still feels like a penalty. Meanwhile, the people who bought earlier got to refinance. The people who already owned assets got the benefit of policy changes. David got delays, higher costs, and the stress of feeling like he did everything right and still got punished. And here is the part nobody wants to say out loud. David is not unlucky. David is correctly placed in a system that transfers value from wage earners to asset holders whenever policy shifts. Now you might be thinking, why does gold keep coming up in these conversations? Isn't gold just a shiny rock? That is what people say before they learn how policy affects the purchasing power of currency. Gold is not just a commodity. In practice, gold acts like money when trust in paper money is under stress. You can see the behavior in every cycle. When investors think inflation might accelerate again, or when they think sovereign risk rises, or when they think currencies can be debased relative to others, gold demand spikes. But in 2026, gold demand is not driven by vague fear alone. It is driven by specific trade and policy incentives that make gold movement rational. And here is where we pivot from central banks to taxes, trade, and the kind of incentive that turns traders into hoarders. Suppose you are a gold importer. You buy gold in one jurisdiction and you sell it in another. Your profit depends on your costs. If a government suddenly changes tariffs or import duties, your marginal cost changes overnight. And when costs change overnight, traders do what rational traders always do. They front-load purchases. Picture this like an emergency price hike on heating oil. If you think the price is about to triple next month, you buy now, because buying later costs more. In this kind of environment, buyers rush to lock in lower costs. That increases demand in the short term. When supply can't instantly expand, prices spike. And once prices spike, momentum attracts even more buyers, especially institutional buyers who can move faster than retail. Now connect that to a central bank story. If a major economy is simultaneously facing currency pressure, debt stress, and trust issues, it will be tempted to steer the narrative. It might declare that its currency is still stable, that its debt is still safe, and that its bond market is still the anchor. But real behavior tells the truth. If gold rises while bond confidence weakens, you have a market disagreement. Investors are saying they no longer want to be fully exposed to paper promises. They want an asset that is harder to print into meaninglessness. Now we need to escalate. Because gold rising is not automatically good for everyone. It is profitable for some people and devastating for others, depending on who holds what, who borrows what, and who can move money across borders. And this is the part where the conversation gets truly ugly. Who actually benefits when gold rises? A lazy answer is people who buy gold. But a more accurate answer is people who control the system and the timing. If you think gold is only about retail investors going down the rabbit hole, you are missing the bigger structure. Central banks and large institutions have a different objective than you do. Your objective is to protect your wealth. Their objective is to shape the monetary environment. If central banks accumulate gold, they reduce their own exposure to currency collapse risk. They also strengthen their ability to negotiate. And they also influence domestic and global markets by signaling a preference for asset-backed trust. Now, here is the uncomfortable mechanism that ties to accounting. Central bank balance sheets can label assets at outdated or conservative values. If gold holdings are recorded at figures that do not reflect market reality, then the published balance sheet can hide the scale of the protection being built in the shadows. So while you see a headline number that looks manageable, the real value can be materially larger when the market reprices it. That means the institution has more leverage than the public can easily infer, and leverage matters because in a currency fight, leverage is the weapon. If you can move first, you can sell later at better terms. If you can finance risk cheaply, you can survive shocks that wipe out weaker players. Let's connect this to a moment that many people remember: the way certain financial institutions in the recent decade collapsed under interest rate pressure. Many banks held large portfolios of fixed income assets. When rates rose, those assets fell in market value. If you hold bonds to maturity, you can pretend the decline is only paper. But if you need liquidity, you cannot pretend. You must sell. And when you sell, you lock in losses. That created chain reactions in banking systems. Depositors get spooked. Liquidity gets tighter. Loans get pulled. Credit shrinks. Then the real economy takes the hit. The people who were told stay invested learn the hard way that paper losses can become real losses fast. Now translate that to currency. If a country loses confidence in paper promises, it tries to move toward assets that preserve value. Gold becomes one of those assets. So gold demand can rise at the same time that confidence in certain bond markets weakens. This is not a conspiracy. It is a rational response to risk. Now, here's the next cliffhanger idea that changes how you interpret 2026. When the Fed maintains a restrictive environment or when it becomes unpredictable, it affects the dollar. And the dollar affects the global financial ecosystem. Many countries run on dollar-denominated debt or need dollar liquidity to pay for imports, energy, and debt service. When dollar conditions tighten or currency confidence weakens, capital flows can reverse quickly. When capital reverses, weaker currencies get hit. When weaker currencies get hit, inflation becomes import inflation. And when inflation becomes import inflation, households suffer first. So while you are looking at your own bank balance, world leaders and central banks are watching something else: currency stability and funding conditions. Now, let's bring this home to the question you started with in your own mind. If you are a wage earner, what can you do? You cannot control policy. You cannot run your own central bank. So what do you do when the rules are rigged toward asset holders? First, you stop pretending your situation is normal. Your job is not just to work. Your job is to manage risk in an environment where the baseline assumption of stable purchasing power is gone. In 2026, there are two major risks for ordinary people. One is employment risk due to AI adoption. The other is purchasing power risk due to monetary policy and currency weakness. AI risk is personal and immediate. A call center that used to have thousands of jobs now has automation and fewer heads. A middle management layer that used to coordinate tasks now gets replaced by software that coordinates without asking for raises. Even creative work is not safe because AI is becoming better at generating content with less human oversight. So your income becomes less predictable. And when income is less predictable, savings matter more. But savings do not automatically protect you because inflation can eat them and exchange rate pressure can reduce their value. That is why gold is showing up again and again in these discussions. Because gold is an asset that has a long history as a store of value when currencies weaken. But here is the dark twist: the world does not only buy gold, it also uses gold strategically. And that means gold can rise not because everyone suddenly loves safety, but because institutions are hedging against a specific monetary path. Now, another micro story to sharpen this. Imagine a small business owner in a country where imports are expensive, their supplier charges in dollars. If their local currency loses value against the dollar, their costs jump even if the business did not change anything. So the owner either raises prices and loses customers, or absorbs losses and eventually closes, or cuts staff. None of these outcomes help the average worker. Now imagine that in the same period the owner hears that trade tariffs are increasing. That increases costs again. So even if interest rates are stabilizing, real life continues to worsen. That creates a reason for capital to move into hard assets, not because people suddenly become geniophiles or collectors, because they are trying to stop the financial bleeding. So the gold narrative is not only about gold, it is about what happens when your currency is no longer the anchor of your life. Now, you might ask, what about your retirement? What about the promises that were sold to you? This is where the retirement crisis becomes part of the same story. Social Security timelines keep getting pushed out or underfunded. Pensions are under pressure. People are living longer, which increases benefit obligations. At the same time, asset prices can inflate without delivering real purchasing power to retirees who rely on fixed incomes. And if you are counting on a safe bond ladder or on steady yields, you are assuming a stable interest rate world. But we have not been in a stable interest rate world. We have been in a world where rates move quickly, and when they move quickly, bond prices move against you. That is why the safe income story can become dangerous. And if your savings are in cash equivalents that earn some interest but still get outpaced by inflation and currency effects, your real balance declines. The decline can be slow, like a leak in the wall. No one notices the moment it starts. They notice when the damage is visible. This is why the wealthiest people do not just buy assets. They buy time and protection against policy mistakes. They allocate to assets that tend to retain value when paper promises weaken. Now, let's talk about the creators, because in 2026 the internet still sells fantasies. You are shown a screen where someone claims to make passive income from content, but most creators earn nothing or near nothing. The illusion is profitable because it sells hope. Meanwhile, the people who actually monetize the system are the platforms and the advertisers and the investors who own the infrastructure. If you are one of those creators earning small or inconsistent amounts, AI changes your competitive landscape too. Your audience can be served by synthetic content, your niche can be automated, your revenue can collapse without warning. That leaves you with stress and less savings, which makes you vulnerable to bad financial decisions. So the creator economy can amplify the same risk: fewer stable incomes, less capital, and a harder time building a buffer when inflation and housing squeeze continues. Now, connect that to global debt. The world's debt is over $300 trillion. That is not a metaphor. That is a balance sheet reality. When debt is huge, the system cannot easily reduce rates aggressively without triggering instability. When stability depends on confidence, and confidence depends on monetary policy credibility, you get a situation where central banks are forced to manage outcomes rather than achieve perfection. That means volatility remains. That means currency pressure remains. And that means the incentive for hard assets remains. Now we finally get to the heart of the gold fight. What happens when the world changes how it treats gold and currency at the same time? There is a narrative you have heard: the dollar is the global reserve, and therefore the dollar is safety. But reserve status is not a law of physics, it is a network effect. It continues as long as counterparties believe in the system and continue to participate. If a major economy starts treating gold as more directly comparable in value, or allows broader legal acceptance, or changes the way taxes and import rules influence gold movement, it changes investor expectations. Even if it does not formally restore a classic gold standard, it can shift the market psychology. And market psychology affects behavior. When behavior shifts, prices move. When prices move, political narratives follow. That's why gold can surge even when people argue about whether a real gold standard is returning. Markets do not wait for official speeches if the incentives and hedging behavior already changed. Now, here is where I connect this back to the earlier point about timing. Central banks and large institutions can hedge early. Retail often buys late, after price moves are already in progress. That is not because you are dumb. It is because retail lacks faster channels and lacks institutional research access. But it also means if you buy after a spike, your risk profile is different. You can still make sense of the allocation, but you should not pretend there is zero risk. Gold can adjust, it can correct, it can fluctuate. The goal is not to chase the highest price. The goal is to manage the role of gold in your overall safety plan. And now I will say a clear thing that people hate, because it destroys the fantasy that you can simply set it and forget it in a world of policy-driven volatility. If gold is acting as money because people are losing confidence in paper promises, then the same forces that lift gold can also cause rapid corrections when markets overreact or when short-term liquidity improves. That means